What's happening with the Eurozone crisis? Well, for the time being, financial markets are giving policymakers the benefit of the doubt. A second round of 3-year liquidity support from the European Central Bank and the Greek debt deal were greeted with relief. But the optimism may prove temporary, as the support from the European Central Bank is merely a stopgap, not a permanent solution. Moreover, the Greek debt deal is less effective than it may seem. Private debt holders contribute around €100 billion up front. But much debt was held by Greek banks and social security funds. Holes in their balance sheets need to be plugged by the Greek government. Therefore, the effective debt reduction is much smaller. Greece will probably need more EU support in a few years' time. Elsewhere in Europe, economic data remain mixed at best, with no firm signs of a recovery yet. Additional austerity efforts in Spain, Belgium and the Netherlands pose further growth risks. The US is doing somewhat better. But a major risk for all economies is a rising oil price. We now expect an oil price of $130 per barrel at the end of this year. As a result, we have revised up our inflation forecasts, and further rate cuts by the ECB look unlikely now. The crisis mood of a few months ago has given way to cautious optimism. But additional austerity and expensive oil still have the capacity to stall the economic recovery.